Major funding for these programs is made possible by grants from Perfect Building Maintenance and Murray Hill Properties, SJP Properties, Greenberg Traurig. Additional funding for these programs is made possible by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, First American Title Insurance Company of New York, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, Herbert J. Sims & Company, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, John Katzimatidis, Kilroy Metal Products, Marcus and Millichap, Massey Knackle Realty Services, M&T Bank, Madison Realty Capital, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sheldrake Organization, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Organization.
Hello, my name is Michael Stoller, host of the Stoller Report, Real Estate Trends in the Tri-State Region. 8 years ago, I started a show called the Stoller Report. It was one of the worst times to be in real estate. There wasn't too much money. There was 9/11. And now, what am I in? I don't know. I mean, the question is, it's difficult. It's harder to get a personal mortgage, harder to get money. So today, I want to know, is there money for real estate? And I've assembled these people who allegedly are still lending, I know they are, who are going to tell us what they like, what they don't like, and what they've seen happening in the market. My guests today are Michael Slocum, Executive Vice President and Head of Lending Nationwide for Capital One Bank, Gino Martucci, Director for Lending for New York City for M&T Bank, Jim Carpenter, Senior Executive Vice President and Chief Lending Officer for New York Community Bank, and last but not least, who was here a year ago on a similar show, Scott Shea, Chairman of the Board of Signature Bank and a partner at Ranieri and Partners. So Scott, it was a year ago, and what did you say then, and what are you going to say now?
Well, as you recall, I was pretty pessimistic. I thought we were just the beginning of the chapter one of the crisis. And unfortunately, I don't even think we've gotten to the beginning. We haven't even gotten to the end of the beginning. I think that a lot of the forces that have overtaken the residential market are about to be full square on the commercial market, and that means that the lack of liquidity that we've seen is going to get even more pronounced. I think it is going to get harder and harder to finance marginal deals. But having said that, just like the residential market, for good loans, for income-producing loans that underwrite well, that have good judgment behind them, there will still be money.
You know, this term, good loan, what's a good loan? What's income-producing loan? I mean, for my audience, which is around the country on the internet and the city, is a good loan a new condominium in Williamsburg or in Long Island City or Lower Manhattan? Is a good loan lending on a piece of land? What's a good loan? Is a good loan lending on an office building that they're projecting rents of $100 a foot while the reality is only $50 a foot? What's a good loan?
I'd say a good loan is lending against in-place current cash flow on an asset that has embedded upside. I have a prejudice towards multifamily finance, but more so centered on rent-regulated multifamily. And
why do you, this is interesting. Why do you like rent-regulated multifamily?
The main attraction to rent-regulated multifamily, not only to investors but also to lenders, is that by regulation the rents are artificially discounted to market. So, working with an experienced operator when he goes into the property, we know that vacancies are actually a positive event, because for an investor that takes advantage of the regulations that exist as units turn, renovates an apartment, and as long as the asset's well located, there's an opportunity to invest more dollars, take advantage of the regs, and increase rent rolls, and over time, ultimately reduce the loan to values. We have issues with operating costs and such, but rent guidelines.
But with operating costs, let's look at it this year. Oil this year is going to go up. Rent stabilization, the increases were not that great. The oil prices are going to be higher. The operation expenses are higher. How's a tenant, an operator going to pay the mortgage?
Well, I think that's a good question, and we haven't done as much rent-stabilized lending. I think our approach is a good loan is a loan to good people, good sponsors, people that can stand behind and have been through the cycles before and have proven their ability to stay behind and stand behind the loans that they have. So a good loan to me is lending money to the right people, because people are ultimately the ones that pay you back.
What happened? Why are we in this credit crisis today? What created this? I mean, we were joking before that your former employer, which was a different division, it was the securities division of Wachovia, created this by lending too much money, really not looking at the situation, by selling off the pieces, by bookmaking or whatever it is. What is creating that, and how are we going to get into better? Because I like everybody's comment. We all want to lend to established people who we like. What happens to that nice person who comes to Signature Bank or comes to M&T or comes to any of you and said, I've been in a different business, but I haven't built 30 buildings. Would you lend to me, or do you have to go to my friends, the hard money lenders and the sharks?
Well, I do think it's going to be harder for first-time developers to get going. I do think that proven track records, relationships over time, having paid back loans are going to be very, very important. So that first-time developer trying to get going for the first time is probably going to have to look more toward hard money than established financial institutions and build his own track record.
Yeah, I think there's two parts of it. I think those people that have spent the last 5-10 years establishing relationships, building that track record, building up recurring cash flow from assets outside of their development assets, and those banks that protected their balance sheet over a period of time when, answering your question from before, what happened when the makers of risk or the originators of risk and the holders of risk became wholly disconnected from one another. Those banks that didn't become wholly disconnected, but in fact were living with their loans, still have protected their balance sheet.
That's the reason why I have the four of you here,
right? Because
that's the situation.
Exactly. Didn't get caught up. They're still out making, multifamily loans, like New York Community is, like we are, like Scott is. And those developers are going to continue to be able to get financing as well, that spent that time to build those relationships and build those recurring cash flows.
So for my audience and for the real estate people who watch my show, we know there is money for real estate. But what do you, Mike, what is Capital One? What type of real estate transactions would you like to lend on? What's A, B, C, and what's D that you won't lend on? And I'd really like to get that around from everyone.
I think cash flow is probably the most important thing today. So properties that have in-place cash flow and reasonable sponsorship behind them, I think can get done at any one of our institutions. I think that's probably top of the list. Bottom of the list is ground-up construction for for-sale properties in the boroughs or in Manhattan, and I think that's very difficult today because I think everybody believes it's gotten a little overbuilt. A lot of stuff is staying on the market, and there's no point in building another one today. So I think ground-up construction is the hardest, in-place cash flow is the easiest, and everything else sort of falls in between.
How much leverage? At one time, and I'd like everyone to answer this, at one time you could come up with 95% leverage. How much money does that developer or owner have to have in the deal, Mike? 30%, 35%?
I think it depends on the certainty of the cash flow. So you have a very good tenant with a long lease, I think you can have a lot less equity in. If you have a building that's got rents that are over market and there's some turnover coming up, I think you have to have a lot of equity. So I think it all depends on both the building, the cash flow, and the sponsor. You have a strong sponsor behind it. I think we can all stretch a little bit more as long as they're willing to put their name behind it. And I think more and more people are seeing themselves doing that today. And that makes all of us, I think, a lot more comfortable that they're going to be there if rents drop, as we think they all sort of will. And somebody may have to reach in their pocket to support a project.
Gino, you've been an active lender. You've lent with a lot of things that I've been involved with and other things. But you're still, what's your favorite? And you even said before you're doing a condo. But I think you're doing that condo based on certain of the things that Mike brought out before.
Yeah, and we're looking at a condo right now with 42% equity and tremendous sponsorship in a tremendous location. And we're doing them, and that's one of the few we're doing. So we're doing very, very selectively for the kind of people that we've banked for a long, long time. So what do we like? We like what everybody else likes. We like stable, multi-tenanted, typically cash-flowing properties where there's very little risk over the term of a loan. That you're going to.
And what is the instantaneous no? If somebody came to you, what are you going to say no to ASAP? I mean, immediately.
A good customer we're going to listen to about any project. But look, ground-up hotel right now in the boroughs, very difficult to do. I can't imagine us doing that. Land loans, very difficult to do.
It was interesting. I was talking on the show last week about hotels. That hotel financing, only 4 months ago, and I don't know if you've ever done it, and I don't think you've ever done it, you could get it for LIBOR plus 250, 275. Today, the asking price is LIBOR plus 400, or LIBOR being 3, to 600, LIBOR over 600. And it's very dangerous. And unfortunately, that's all I'm seeing. People sending me hotels. One, I think my best example is somebody sent me a hotel on 31st Street and 5th Avenue, and then another person sent me a hotel across the street. 2 new ones. I said, is this the same deal? I mean, how many hotels, how many foreigners, and as the dollar gets stronger, the foreigners will be less, What do you like? I mean, have you ever done a hotel? I know you've done plenty of multifamily.
Hotels came our way through acquisition. It was indigestion for us, and it's an asset class that we just, stayed away from. Not to say you can't underwrite them appropriately, but just not our cup of tea.
But I mean, in reality, everybody here does multifamily, but the kings of multifamily, and who's done a great job, is New York Community Bank. I mean, and the best example is Co-op City. Co-op and all these others that you've been there, you love multifamily and you've lived by it, and you keep it on your books. Right. Besides multifamily, what else do you like doing?
Well, the remaining 25% of our book is commercial real estate, retail, office. But in those, as Gino mentioned, we like multi-tenanted situations where there's some dispersion of risk. If we get into industrial, we like multi-tenanted, light industrial. I would say, we're at 65% LTVs, 130 coverages. Particularly in the light industrial, those leases tend to resemble multifamily in that they're shorter term leases, 2, 3, 5 year leases.
Are you worried about the boroughs? I mean, because many people, talk too much and they say Manhattan centric. Are you a little cautious about, let's say, Brooklyn or Queens or Staten Island or the Bronx?
I think with Brooklyn, you need to be concerned about all the new product that's coming out of the ground and is yet to be delivered. I'm sure many of us have seen deals come in where we see condo jobs redirecting to rental, and there's equity, whether it's mezzanine debt or preferred equity, stuck in the deal, and permanent financing coming our way and searching for dollars that really aren't out there, and how do they take it out? And that's where we always look at the exit strategy on the going in. So,
Scott, I've known Signature since the beginning, our involvement together. But, Signature, for many years until, let's say, the last year, was basically a quiet player in the real estate market. I mean, very personal one-on-one relationship, rather similar to M&T. And now you're into the real estate market. As Matt Galligan said to me on the show last year when I did a money show, he said, I'm with Bank of Ireland, all of a sudden I come into New York and then I shouldn't be lending. But you've gone into that very heavily.
Right, actually, to a great degree since the last show. First, I'd say our focus is also multifamily. Probably 55% of our portfolio is multifamily, so we agree with your assessment. Multifamily is the place to be. Our lending area is basically 75 miles around Manhattan. So it's those are markets that we can drive to, that we can be quite familiar with. And my belief is that it's always better to get into a market at a time when you're not just another participant, among a variety of participants, among
ease of entry because there are less players.
Much easier to get into, much easier to select good loans and focus on good people, because frankly, people are looking to develop relationships, develop folks who had properties with banks that may or may not be doing so well. Well, now they're looking to redirect the relationship. So we've built the bulk of our portfolio really in the past year, and we're planning on continuing to do that.
Now my question is, there was a term for my viewers who don't understand the word recourse. For many years there was never this. Recourse means guaranteeing. Now it's come back to the dictionary. Remember Norman Stern is saying to me, I don't know that term. It's not in my dictionary. What's happening? Are you requiring your borrowers to guarantee the loans?
Frankly, more and more loans are getting done with recourse, whereas a year ago, certainly it was, in many cases, developers or owners could negotiate recourse away. Now that's becoming less feasible, but I will say that for cash flowing, income producing properties, it's still possible to do non-recourse deals. You can't do that deal, though, if there's any risk to it. Those are for the risk-free deals. Those are reserved only for risk-free deals.
I mean, when you look back at how this cycle evolved, construction, finance, it was almost sacrosanct. Recourse, personal recourse for completion and repayment. And as we went through the last 10 plus years, we had new market entrants and bought their way into the market, and we saw non-recourse deals being done on the construction side, or recourse to the entity, which is basically smoke and mirrors. Now we've gotten back to a more, I think, appropriate underwriting standard. But as we move to income property, we're still generally on the non-recourse side, provided we're lending against cash flow in place. If we go to an owner-occupied or user-type facility where we're lending against the entity, the going concern, then recourse would be
Gino?
required.
Anything where there's a risk to cash flow, we're going to require recourse to bridge that.
I think the securitized industry took recourse away because the people buying the bonds didn't care about if there was a guarantee. They just looked straight at the real estate. And now we're all holding on to these loans, and it's important.
But I think that relates a very good point. And we joke about it because Scott's partner was the king who originally created securitization, but he created securitization at a time when there was normalcy on when they put things into securitization. What happens today, how do you look at appraisals? How do you look at rating agencies? How do you really look at this? I know Jim has an interesting thing because the New York Community Bank, their appraisal department really is like in a credit decision with you. I mean, there's a double-sided coin. You really count on your appraisals, but your internal appraisal department.
Well, I mean, we look at cash flow. I mean, to me, an appraiser and an appraisal is just that. That doesn't get you paid back because that can always move. But what happens to the cash flow and where's it coming from and what kind of tenants do you have is important. And we'll look straight at that, and we get an appraisal because we have to. But
right,
we don't get the appraisal and say, well, if it says X, we're going to loan 70%.
But my big question is, unfortunately, we are our own worst enemy. We go back to things. Right now, we're tightening up. How long is the tightening, and what happens when that new entry, or when the new Lurinary super broker street guy comes out with the newest securitization? No more CMBS, it's CMX plus. What happens to the world again?
Well, first of all, there's always a cycle. I mean, now we're in the cycle where they're hunting CDO originators down with dogs, actually. I mean, and where securitization is so out of favor. I think you mentioned a pre-show. There hasn't been a deal done in the last 2 months.
Last 2 months.
And who knows how long that's going to be. I think it's going to be quite a while in this cycle because there's literally hundreds of billions of dollars of of loans that are going to be regurgitated out of securitizations over the next few years that have been done that are going to need to find homes in places like the institutions you're talking to here.
But that's a big problem. These loans, which may have been done via securitization under the assumptions that the rents were going to be X, or all the situation, and they didn't take into the correct oil expense, the operating expenses. How are these people going to come to it? Because right now, it's not happening to any of you, but it is happening to certain banks who are sitting on loans. I know iStar is sitting on that because of a lot of the Fremont and the Chorus, where when they started the project, the construction was X. Steel has gone up. Costs have gone up, all these expenses. What's going to happen to these CMBS? How are these loans going to get repaid?
Well, it is going to be tremendous spread widening because, frankly, a whole bunch of people are going to be offered these loans who really don't want to make those loans or are going to need to be enticed into making those loans by sharply wider spreads. So that's part of the reason my first comment was, I think we're perhaps at the end of the beginning. We're certainly not at the beginning of the end. This is a long cycle.
Deals are going to have to cycle themselves through, and I think that some pills are going to have to be swallowed, and there are going to be lenders taking losses.
It's very interesting. I was sitting with a bank, a foreign bank, I don't want to say what, a European bank, who was a very active and really good friends, and they said to us, we had a loan, we needed $19 million, and they said, it was truly a relationship. They did the loan because of a relationship. And we said, how would you price the loan today? He said, we haven't done a loan in 6 months. And if we did a loan, we don't know because where we are in Europe, we don't have a depository means of getting our money. So we don't know what we're borrowing at. We have no idea of what we can charge. We're caught into this situation. CMBS, you hope the guy sold the paper.
Mike, I think you have to, we can't with a broad brush talk about all CRE and not give some consideration to the fact that there are pockets where deals are less risky and have more value to lenders and investors. And so, as you said, a hotel deal or a retail deal at steep market rents, that's a heck of a lot more risky than doing a rent-regulated multifamily building. But deals are going to have to cycle themselves through.
With regard to the cycle, in the 90s, unfortunately, I did own some stock in some S&Os who were worthless. They good little pieces of paper today. Do you see any of the local banks in this area? I'm not saying, I know it's not the four of you, going into the situation of being taken over. I mean, I noticed this weekend on the newspaper another bank was taken over. Do you see any more banks in the local area being taken over by the government? Anybody want to?
I don't think so. I'm familiar with the bank in Atlanta that you're talking about, the Integrity Bank, I think. And I think there's going to be a lot more in the southeast and maybe on the west coast. But I think the market here, unless it deteriorates a great deal more than it has, won't see any of that. But be curious.
I think this is a lot more resilient to marketplace than other areas in the country, and it's geographically centered.
We were bringing up before with regard to the boroughs, and I always joke because I've done a number of shows on Brooklyn. I've done every borough except for Staten Island. I know Molinari is going to scream at me, but we'll do it this year. What do you think of the boroughs? I mean, I know you're in Long Island City in certain projects. I know that Capital One's all over. I mean, what do you think of the boroughs in general? I mean, forget the rent stabilized, because rent stabilized and the boroughs are different. They're the same, but they're different. Because people rent at a different price in the boroughs.
I mean, I think, you sort of look at the pyramid, and in Manhattan, you're at the top of the pyramid, and as you go to the bottom, you have a lot more people spread across a lot more areas. So, I mean, I frankly think Queens, Brooklyn, I think those boroughs are fine. There's a lot of people, that's where people live and work, and
I mean, Capital One has a big presence in Long Island. You've built a presence in Long Island. You have a small presence. You're a gigantic presence in the island. I mean, what do you see with regard to Nassau and Suffolk County? I mean, with the economy and the real estate market. Gino, Mike? Jim?
With regard to commercial real estate?
Yeah, with regard to commercial real estate.
We're not doing quite as much as you might think out there. Most of our business is in the boroughs, but we do occasionally do some smaller strips, some office, but to a much lesser extent, it's it's a secondary market to the city. But we certainly look at deals. I think it's healthy. But again, our preference, we're really where the opportunities are for us have been in the boroughs. We're very much broker driven, and for lack of a better reason, the brokers that we deal with tend to source business out of the boroughs as opposed to the island. The island is much more of a direct relationship lending environment. So that's why you've seen North Fork and Capital One have a little bit more inroad there.
I think we see as long as there's employment, as long as unemployment doesn't go up too high, and it hasn't, that those markets will remain pretty strong. We've done suburban office, we'll do retail shopping centers, and we haven't seen deterioration in the market out there. We have, if you go the other way into New Jersey.
New Jersey is a
issues.
tough market, with the exception of the Gold Coast, which is Jersey City and Hoboken. The market is really difficult, and it's a market that I know with the Apollo and the other situation, it's not a time to talk. It is a tough market, but
we're still active in. I just should note we are active in Nassau and in Westchester, to a lesser degree in Suffolk as well, and relating to primarily they're more commercial real estate because there's not a lot of rental, there's not a lot of multifamily. But I do think the big risk is, and I don't want to take this too macro away from where we are, but if you look at what's happening to overall consumer expenditures, a couple of years ago, the consumer spent 50% of his or her income on food, energy, and financial obligations. That's now up to 56, 57%. Hopefully oil will come down. Plus, nobody was saving money. So you've had a tremendous decrease in the amount that consumers can spend on retail, and I think that's going to be...
I think that's definite. I'm happy that, hard to believe, 30 minutes have gone by, but I'm really happy that 4 people who are still in the business, who continue to be in the business, have said there is money for real estate. I'd like to thank Mike Slocum, Gino Martucci, Jim Carpenter, and Scott Shea. I'll see you next week.
Major funding for these programs is made possible by grants from Perfect Building Maintenance and Murray Hill Properties, SJP Properties, Greenberg Traurig. Additional funding for these programs is made possible by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, First American Title Insurance Company of New York, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, Herbert J. Sims & Company, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, John Katzimatidis, Kilroy Metal Products, Marcus & Millichap, Massey Knackle Realty Services, M&T Bank, Madison Realty Capital, Meridian Capital Group, Newmark Knight Frank, Must Development, Palin Enterprises, Rosenthal & Rosenthal, Signature Bank, Sheldrake Organization, Sterling & Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Organization.